Corporate finance practice problem using OneNote. Bond refinancing decision problem number 1. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we are in the Practice tab as opposed to the Example tab. The Example tab, in essence, being an answer key. Information on the left-hand side, we're going to populate that information into the blue area on the right-hand side. Taking a look at a bond refunding decision. Scenario being, we have a bond obligation outstanding, $20 million. Issued at the 14%. The current rate is 12%. So the question here is, well, what if we were to reissue the bonds at the lower rate, the current market rate at the 12%? Would it be worthwhile for us to do so? So then we have the original issued for years. We issued it originally. In other words, the original bonds issued for 20 years. The years remaining at this point in time are 10 years. Now, if we were to issue the new bonds, we're assuming we issued them out for the $20,000 at the current rate of the 12% for the remaining time period that would be there on the old bonds, basically kind of refinancing them here at the 10 years. So we could say, okay, well, what would happen if we reissued these 10 years at the new current lower rate? The call premium on the old issue, so in other words, for us to basically retire the old issue, we can call them at 8%. So we're going to have a cost there. We have underwriting costs on the new issue. So it's going to cost us $550,000 on the new issue to issue the bonds, basically float the bonds. And that is something that's usually going to have to be amortized over the life of the bonds with regards to taxes. So it's usually an expense. We're going to have a tax impact of it, but we'll also have to consider the fact that it's usually amortized over the life of the bond. So taking that into consideration, the old issue had the costs to issue it when we issued it of $430,000. Once again, that cost, although could have been paid up front, we will assume it was, for tax purposes, has an impact over the life of the bonds, which we would now think about expiring. So any unamortized premium we might be able to pick up at this point in time for that cost that we sent out at the beginning of the old issue, which hasn't yet been taxed. We have a tax bracket. We're saying 30%. Discount rate is going to be the 9%. Okay, so let's do our calculation here. This is one of these differential type of calculations where we're trying to say, is this something that's kind of like a capital project type of decision in that it's a long-term type of decision. We're trying to see if it would be worthwhile for us to make the decision. We're looking for a differential type of calculation. Where would we be under the old circumstances? Where would we be under the new circumstances? Or in other words, what are the things that are different between the two alternatives that can help us with the decision-making process to see if it would be beneficial or not. So first, we're going to calculate the net cost of the call premium. So net cost of the call premium, we're going to calculate the cost before taxes. It's going to be the bond obligation. So let's pick up the bond obligation. I'm going to put that on the inside. That's going to be the $20,000. It's going to cost us 8% to call these things. So that's going to be a cost up front for us at the 8%. So the $20,000 times the 8%. Let's make that a percent. Numbers group, percentifying it, font group, and underline it. Then we'll multiply that out, this being equal to the $20,000 times the 8%. Then that's going to be the cost before taxes. And let's go ahead and do some indentation there. I'm going to select these cells, go to the alignment group, indent. Going to indent this one more to get the cost before taxes. Then we have the tax impact, which I'll kind of do a quick calculation on here. Notice down below we have the 30% tax bracket. I want to take 1 minus that 30% to get the difference of the 60%, or the 70%. So we're going to say this will be a percent, number group, percent, font group, and underline. So the tax impact percent. Indenting that, home tab, indent. This is the tax rate. Let's go ahead and mark that as the tax rate, tax bracket that we're in. And indent that. And there we have it. Putting this on the outside, this is going to be 1 minus 30%, or the 70%. Numbers group, percentifying that, underlining it, font group, and underline it. That's going to give us the net cost to call the premium. So the net cost is going to then be the 1,000,006 times the 70%, which is 1 minus the tax rate. Now let's take a look at the underwriting costs and the tax impact. So we're going to take the underwriting costs. That's on the wrong cell. Up here, underwriting costs is going to be equal to, this is the cost for us to basically issue the bonds. So the underwriting costs on the new issuance of the bonds. Then the issue years, we're going to say, are the 10. So we're going to issue these for the new 10 years that they're going to be issued for, because they're going to match the remaining life of the old bonds that we have out there. We're going to underline that, font group and underline. That'll give us then the 50,000 over 10. So in other words, we would be spending the 550,000 more, and we'll imagine we'll put that out up front, but then we'd have to amortize it over the life for taxes typically. So this is going to be the the yearly tax expense that we're going to have a tax benefit on. So once again, the whole 550 we're imagining going out at this point in time in terms of cash, but the tax benefit having an impact over the life of the bonds 10 years, which would be the 55,000 that we'd have a tax benefit per year, basically, and expense per year for the life. And then we're going to take the tax rate, which is 30% on the tax rate. And let's make that a percent by going to the numbers group, percentifying it, font group, and then underline it. And that's going to give us our underwriting costs after taxes, which is going to be let's call that our underwriting yearly tax benefit. And that's going to be the 55 times the 30%. So we're going to get a tax benefit, we think, of the 16.5 for the 10 years. Now, to calculate our calculation to see whether this would be beneficial or not, we want to do the present value of that, and we're going to use our discount rate of the 9%, because this is going to be the 16.5 benefit over 10 years. Let's discount it back so that we can get the present value using the discount rate of the 9%. So this is similar to what we've seen in our capital budgeting type of decision-making processes, discounting this back. So I'm going to say negative present value, shift 9. The rate is going to be that 9%, comma, number of periods is going to be the 10 periods, comma, and then the payment is going to be that amount that we just calculated up top, and we're going to say enter. So that'll give us the 105,891. Let's add some pennies to it. Add a couple pennies. So there we have it. So there's the present value of the tax savings. So once again, tax savings of the 16.5 per year for the cash outflow that went out up front of the 550. If we want to then get the tax benefits to one lump sum number, the present value of it, then we do our present value calculation. We have the 105,892. So let's kind of sum these up. We're going to say, all right, the net cost of the premium, we're going to have up top, the net cost of the call premium is going to cost us, and we'll pick up this amount, the 1120000, the 1,120,000, and then we have the underwriting costs. The underwriting costs, that's the total outflow. The total outflow was the 550 that we're imagining going out now. And then we're going to take a look at the tax saving, present value of the tax saving, given the fact that we once again had to expense that over the life of the 10 years. And if we present value the benefit there, I'm going to make this a negative of that 105,891. Underlining that, that's going to give us then our present value of the outflows. We're going to say present value of the outflows equals the sum of these items. So we got the 1,156,108. Okay, so now we're going to go back up top. We're going to look at the net annual interest savings. So this is going to be the benefit due to the difference in the interest rates. So we want to take a look at the initial rate versus the current rate. So the initial rate, let's call it initial rate. Initial interest rate versus the current interest or new rate for the new issuance. So we issued them before at the 14%, in other words, and now we're going to be issuing the new ones at the 12%. That's what started this whole thing, because that might be beneficial. Home tab number group, and we'll percentify that. Then we're going to put an underline here. So we're going to go to the font group and underline. That's the difference, is going to be equal to the 14 minus the 12%. Let's make that into a percent by going to the number group and percentifying it. So we'll compare that to the face amount of the issuance. So the face amount is going to be 20,000. 20,000 at the 2%. That's going to give us the net annual interest savings. So we got the annual interest savings because this is the annual interest rate. So if we have the old issuance versus the new issuance, they're both at the $20,000 of the face. So we're then going to take this equaling the difference of the 2% times the 20,000. That's going to be our savings. Notice this is a differential calculation. We're looking at, the benefit between one decision versus the other. That's the 400,000 for on an annual basis. Let's take a look at the tax impact. So I'm going to say tax impact, say percent, or one, let's call it 1 minus the tax rate, which is going to be equal to 1 minus the tax rate. And that's going to be the 30% over here. 1 minus the 30%, making that into a percent gives us 70%, number group, percentifying it, underlining it, font group, and then underline. That's going to give us the net annual interest savings. So the net savings is going to be the 400 times the 70 after the tax impact, and that's going to be on an annual basis. So once again, we would like to get our one number here, which we use our present value type of calculations in order to do, similar to our capital budget type of calculations. So this is going to be happening over the life, which is going to be the 10 years. So let's do our negative present value, shift 9. The rate is now going to be the 2%. The rate is not the 2%. The rate is going to be our discount rate of the 9%, comma, and then the number of periods is going to be 10, which I can pick up. Let's pick it up over here, 10 on the number of periods. And, well, let's pick it up actually over here. So we'll say the new issuance was 10. So we'll say 10 on the new issuance, comma, and then the payment is going to be this amount of the 280 that we just calculated, 280,000, and enter. So there we have the 1,796,944. Let's add a couple pennies. I'm not sure we really need the pennies for that's probably not going to affect our decision making, but we'll add the pennies anyway. So there's our annual interest savings. If we present value it, that's probably again the thing that kind of started us into this whole decision making process. Then we've got the underwriting costs. So let's go to the underwriting cost of the old issuance. So the old issuance, we had to pay $430. Now, that's not impacting the current period because we imagine we already paid that before, but there's a tax impact on it that we got to take into consideration because we usually amortize that over the life of the bond issuance. But if we remove the bonds now, we might get the full tax benefit of the unamortized premium at this point in time. So the cash flow for this already went out. We're looking at the tax impact related to it. So the years covered were 20. They were originally issued for 20 years. In other words, if I underline that, that means that the cost per year, if we had a straight line tax benefit of this, would be the 430 divided by the 20 years. And that would give us the 21.5. So that would be the cost per year or the tax benefit per year. Now, 10 years has already gone by. The years that are remaining are going to be the 10 years remaining. So that means we have an unamortized amount of benefit, which is the 21.5 times 10. And let's underline that. That's going to give us our unamortized cost that we have not got a benefit from. So once again, we paid the 430 already. Then we get a tax benefit, kind of like you would do for a fixed asset type of calculation, like depreciation type of thing. And we're going to divide it by 20. That means we're going to get a benefit of the 21.5 per year on taxes, even though we already paid for it. That tax benefit had already been consumed for 10 years, the life up until this point. And so there's 10 years remaining. So the 21.5 times the 10 years remaining is the 215 that is currently unamortized. Now, normally, if we were not going to retire the bonds, in other words, if we didn't call them, then we would be able to take that 215, but we'd have to take it over the next 10 years, 21,005 per year. If, on the other hand, we call them, we may be able to get that 215 at this point in time. and get the deduction now. So we might have that time value savings that's going on here by us being able to take the deduction now, considering we're retiring those bonds and this is a cost related to them. So we have to look at the difference then of our decision-making process between the tax impact here, which would be over 10 years, versus if we took the amount today. So let's take a look at the present value of the unamortized portion, and we'll see the difference. So this will be the negative present value, shift 9. The rate is going to be our discount rate again of the 9%, comma. And then we want the number of periods, which is going to be 10, comma, and then the payment is that 21.5. So the 21.5, enter. So in other words, if we did not retire the bonds, we would get the 21.5 for the next 10 years, which would add up to the 215 total deduction. But present valuing that at our discount rate means it's only worth the 137,980. If, on the other hand, we retire the bonds, we may be able to get to the expense related to the full unamortized portion at this point, since those bonds are now gone, which means we'd get the full amortized amount today. So we have that timing difference. The net dollar amount would be the same over the 10 years, but we get to take the benefit today. So that's going to be the difference in our calculation. Okay, so then if we then have the gain on the unamortized cost, we're going to calculate was the 215,000 versus the present value, which is going to be equal to the 137,980. That's going to give us the basically we'll call it the gain on the cost that we get to take by exercising by retiring the bonds, right? And that's going to give us the 77.20. Let's add a couple pennies here. Let's add some pennies up here too, just to give it a little bit more detail in case you want the pennies. We'll add pennies to all these. Add in some pennies, and then we'll take the tax rate. So the tax rate, which is tax bracket 30%, tax bracket at the 30%, numbers group making that a percent, underlining it, font group, and underline it. That's going to give us our cost tax savings, which is going to be equal to the 77.20 times the 30%. So we've got that tax benefit there. Let's add some pennies to that to be consistent. So there we have it. So then we got the present value of the cash inflows, which is going to be the present value of the interest savings, present value of the interest savings up top. And we have the cost savings, tax savings here of the 23,106, underlining that, font group and underline. And that's going to give us our present value of cash inflows equals the SUM, the sum, and that gives us the 1,820,050. Okay, so now we can sum this thing up and say, all right, the net present value is the present value of the outflows that we calculated over here. Here's the outflows. I'm going to make that a negative for the outflows, negative on the outflows this time. Make it a negative for the outflows, the 1,564,109. And then we've got the present value of the inflows that we just calculated. Present value of the inflows, and that's going to be equal to then what we just calculated, the 1,820,050. Adding that, let's add some. Should we do our decimals there again? Add some decimals here. Do that. We'll add some decimals down here too, just to be consistent with the pennies. Don't want to miss the pennies. All right, and then we're going to sum that up. Equals the SUM. And there we have it. We'll underline it here, font group and underline. So it comes out to a positive, so that if it's a positive, we think it might be a beneficial then decision to make. Similar kind of process with the capital budgeting type of decisions, those longer term type of decision making processes.